hang it in there.
Yeah.
Yeah.
So all kinds of good
Still
thoughts.
have
and
people
your way.
joining, but we'll go ahead and get started once this last one joins. Eric, are you the co-host?
I am not.
Okay. I'll just keep an eye out.
Okay.
All right. Let me move this guy. Thank you guys so much for coming today. We are doing the Realtor Reference Guide. And obviously I am Carlin Ham. We also have the privilege of having our regional manager, Eric Spotswood, here with us today. And he is going to just chime in and give his little opinions and, little chime-ins whenever he feels like it.
Dory, why do you smirk when she says that? Dory, I know Eric's not going to be quiet. I saw that, Dory.
We love it. We love it.
Not a poker player, sorry.
I love it.
So we're going to talk a little bit about everything. We're going to talk about who is Prosperity, what our loan limits are, closing costs versus prepaids. We're going to talk about credit, VA loans. We're going to talk about everything. So let's continue on. I wanted to start with something that is really important to me. Laurel knows this from my vision board activity, but what is our why and why are we here? And what are we even in this for? So Prosperity Home Mortgage, we began in 2006. We're from the Carolinas and then quickly spread all over the nation because we are the very best. We were voted the best mortgage company in the nation by Mortgage Executive Magazine 8 years in a row. No big deal. While we're nationwide and very well known, we are very local with accessible leadership and awesome leadership, mortgage consultants, processors, and even appraisers. So we're all local and we are all really familiar with the area. So that is a real benefit of using Prosperity Home Mortgage. In addition to the fact that we are Berkshire Hathaway owned, so we are serving our realtors and you guys are our #1 priority and you are the heart of our business. So that is our why. That is why Prosperity Home Mortgage was founded. And I am so incredibly blessed to be a part of it. And Eric, I know you probably would echo the same thoughts.
In 20 years of doing this in the business, this place has the most support and the most just like-minded thinking of everybody at the top of the house, where everybody's just solutions-oriented thinkers. How do we get things to the finish line? How do we make sure clients are happy? Because we're just like you. We're not transactional thinkers, we're relational thinkers. So how do we make sure that we're building business that comes back time and time and time again and keeps your clients smiling? So it makes our job a lot easier.
On that same exact note, our mission. So I love this picture. I feel like it really encompasses like who we are and how we show up to every single transaction. We are a communication-driven lending team that saves you time, which saves you money and allows you to close more deals. And we do this by giving our clients that wow experience that really, really keeps them coming back. And that's really what full service brokerage is about, right? We want our clients to feel taken care of. It's like going to Disney, versus Busch Gardens. Like you feel taken care of, and that's kind of who we are and what we encompass here. And I want you guys to know that that also comes with me being in your office newly. So I feel personally responsible for making sure your clients are coming back to you. And so I'm going to put every ounce of energy into making sure that they're feeling nurtured and taken care of. So I just wanted to put that at the forefront of our meeting so that you guys know kind of why we're here. It's not just about the transaction. It's really about you and building your business for years to come. Now let's dig in to the mortgage stuff, shall we? All right, exciting stuff here. It's 2022, so we've got new loan limits. Our conventional loan limits are going to be raising to $647,200, which is awesome, especially in our market. We have a little bit of a higher price point around here, which means we don't have to send them through the jumbo program, which means less, less documentation, less hassle, less rate, hopefully. Sometimes jumbo and conventional can kind of, but most of the time conventional is going to have that better rate. It's just less risky for the investor. FHA 42680, VA $1.5 million. That's insane. And USDA is going to really depend on the exact property. So we can run the address through the USDA website if you have one that you think might qualify for USDA. Closing costs. So I get this question a lot from realtors and clients alike. Nobody really knows exactly what's going on here. So I'd like to break it down into a couple of different buckets. So closing costs are going to be under one bucket, and they're going to be paid by the borrower in connection with the closing of this mortgage. And that can include all of the things that we're going to go through. So one bucket of closing costs is going to be your prepaids. These are going to be your escrows that you're paying into, your insurance and your taxes. And those are going to be upfront mortgage charges that are going to go into an escrow account in the name of the borrower. And then they're going to be paid on behalf of that borrower when the bills come due. So those are your prepaids. I know it looks like, it's a big part of the closing costs. And so a lot of people look at that and they're like, whoa, but what you guys should know and remember always is that this is basically a savings account for that borrower. They would be paying this monthly anyways. So it's just going ahead and getting that set aside so that they don't have to worry about it when the bill comes due. Non-recurring charges, these are going to be your one-time fees associated with this home purchase. They're going to include your attorney, your appraisal, your flood certs, credit report origination fees. Some companies call them processing or underwriting fees, and some places have all three. So whenever you're looking at the loan estimate, make sure that you're looking for prepaids, you're looking for non-recurring charges. And under non-recurring charges, make sure to look at what their fees actually are. So origination fees are going to be the charge to get that loan. And our origination fee is $9.95. And if there's anything on top of that to buy down the interest rate or anything like that, we're really going through in detail and explaining that to our clients. But we've noticed recently that a lot of lenders aren't doing that, especially when the rate market is like this. They are saying, okay, we can get you into this 3% rate. And then they're just tacking on some origination points in there without discussing it with their borrower. And the borrower ends up at the closing table with $7,000 in origination costs, and they didn't even choose to do that. So definitely something to look out for. And then another thing is origination fees, processing, and underwriting fees. That's just another way that they can go ahead and stuff in more costs in there. We have one origination charge, and that covers our processing, underwriting, origination, everything. And then of course,
takeaway too, if I'd add, the important takeaway too, when you're talking with your clients, a lot of people, and it's completely understandable. Most people are only going to do this a couple times in their life. They look at how much does it cost to set up a loan. They're going to get their fee worksheet. It's called a loan estimate. And they're going to go directly down to the bottom right corner, and it'll show how much you have to bring to the closing table. And then they'll get one from another lender, and they'll go right down to the bottom right corner. So, and I get it. It's the bottom line cost. The reality is 95% of what you see on that loan estimate is exactly the same to a penny, no matter which lender you pick. So your taxes and insurance, they don't change depending on which lender you pick, but a lender can estimate them at different values because we're all using estimated costs. So if one lender estimates your taxes are $300 a month and one estimates it at $250, the one who estimated at $250 is going to show a lower cost, but the reality at the end of the day, it's the exact same. Title charges are the same no matter which lender you pick. Government charges are the same no matter which lender you pick. So if you get that loan estimate in the top left corner, what Carlin's mentioning, the origination fees, that's the only thing that's going to differ at all from lender to lender. So if you get your client, don't let them fall into the trap of just looking down at that bottom right corner, because people estimate fees higher and lower, and it'll make it seem like they're getting a better deal one way or the other. The origination charges is really the key factor in there. If you just zero in on that, the rest of it just kind of falls in line.
right. All right. I always say the fees are the fees are the fees. They are that. And then our last bucket of closing costs is going to be your down payment. And that the reason that I put them into 3 separate buckets is because the seller can contribute to prepaids and non-recurring charges, but the seller cannot contribute to the down payment. That is the client's minimum investment in the transaction, and they're separate. So I do get a lot of questions of, well, I have these seller contributions. Can I use them towards the down payment? And we unfortunately cannot do that. All right, so speaking of seller contributions, this is just a quick guide. Take a picture of it, something to kind of keep on your phone handy. Maximum seller paid closing costs. So if you have less than a 10% down payment on a primary residence or a second property, the maximum seller paid is 3%. Primary or secondary with 10 to 25, 6%. Primary or secondary, 25% or more, 9%. And if it's an investment property with any amount of down payment, the maximum contribution is 2% on the seller contribution. And if you guys have questions, just chime in. We'll pause and take your question. So what in the credit? I know that you guys get the most credit questions, and I want you guys to know you do not need to know everything about credit. Credit is so incredibly sticky that you can say something like, oh yeah, you need to pay those balances down, and it could negatively affect their credit. So don't necessarily be the credit expert, but these are some talking points you can have with your clients if they ask you things that I know that they do ask you. So a lot of the times I get the question, where did you get the score? Because it is not the score on my Credit Karma. And we pull from all 3 bureaus and we take the middle score, and that is what we use to qualify for the loan. And when we have multiple borrowers, we take the lowest of the 2 middle scores. What if our client does not have a credit score? So I've done this many times, non-traditional credit. We can absolutely use credit supplements and alternative credit. We have a chat. Is it possible to give an estimated percentage range for buyer's closing costs at a given purchase price? Yeah, I would say 2 to 3%. 2 to 3%. And I can run a specific scenario for you if you need me to. I can do like a mock-up. All right. So yeah, non-traditional credit. We just need generally 3 trade lines that the client has paid on time and over the past 12 months, and we can use non-traditional credit, which means they do not have a credit score. And no credit is better than bad credit. So if you have people who are like, I don't have any credit, you should definitely tell them to still try to get a loan because it is possible that they can get one without having that. And what is a good score? So a good score, that's going to be completely subjective to the person. Oh, I think I have another chat. Oh, perfect.
Thank you.
And that we've got our conforming and VA loans at 620 or above right now, FHA 580 or above, and jumbo 700 or above. And we actually have an investor that we can use the higher of the middle 2 scores if we have multiple borrowers, which is a new thing that just came out this year, which is huge. So any questions on credit?
No, something to tack in there. Just if you're talking to your clients and they're looking to build their credit, a lot of people, like Carlin said, they feel like when we pull their score, it drops it. So people are worried about having their credit access because they're like, I don't want my credit score access because it's going to drop my score. MyFICO.com is an interesting website, or interesting if you're a mortgage nerd like me. And they did a study. It said the average credit pull only impacts your score by 5 points. So it really doesn't move it very much. And credit's very regenerative. So what people think is what Carlin said, you see it on Credit Karma, or you see it on your banking app, and then it changes and you assume it's because of the credit pull. It's just that the algorithm for mortgage is different than anything else. So you can kind of let them know that that's not really something to be very scared of, because the 5 points is going to come back really quick. And then they can have it pulled. You know, somebody will say, I don't want an access to gain because it was pulled by somebody else. You can have it pulled by 10 different lenders if you do it in a short amount of time, and it doesn't impact your score anymore at all. And then the other thing I put in, if somebody is working on their score, a lot of people don't realize 35% of your score is your balances of your accounts versus the maximum limits. So if you really want to drive the score quickly, you could just move those around. And Carlin has software that can tell them exactly what to do to pay off balances to move to different areas that'll move their score up. I work with somebody that literally had nothing change on their report other than paying off credit cards, and it moved their score up 80 points. So that's, but is a reality to be able to move the score really, really quickly. And Carlin can help you do that.
Yep, absolutely. All right, so these are VA funding fees. Another thing to just maybe take a photo of. If anyone ever asks you this, you can always Google it or just call me or text me. They change depending on if it's the first time use for the veteran or if it's not, and the amount of down payment that they're putting down. More about vets. So we were actually founded by a veteran, and it is very, very, very important to us that our veterans are taken care of. I grew up around a military base. So the military is really important to me. And I know a lot of people who are serving. So I became a VA specialist. So it is one of my favorite loans to do. And I think Prosperity has one of the best programs for VA loans I've ever seen. And we waive the origination fee and we pay for their appraisal. Also, competing against other banks. A lot of my VA clients are like, well, I go to a VA specialized bank and I know that they have like great insurance and whatever, but they don't have the best mortgage rates like at all. So definitely make sure they're getting that second opinion. I've also seen those VA based companies try to get the client to use their realtor, which can definitely mess things up. So be aware of that and know that Prosperity really, really takes care of our veterans. And of course, they're my favorite. It's my favorite thing to do. All right, so we've got our low and no money down options. We've got our USDA and VA programs. Those are going to be no money down required. 3% on a conventional loan if you're a first-time home buyer, 5% if you are not. We also have a Home Ready program, which is 3%. Home Ready is a fabulous program. I use it all the time. You have to be under a certain amount of income, but most of the time the clients are, and it just gets you access to lower rates. Like, why would we not do that? So it's a really great program. And I promise you, I'm running all of your clients through that to make sure that they qualify for that program. FHA, 3.5% down. We also have a 0% down FHA program, which I have done, and it is fabulous. It's got a little bit of a higher interest rate, but for those people who are really just trying to get into that home without having that extra cash on hand, it is an amazing way to get them into that house. Especially with the way that rates are moving and the way that prices are moving, it's really important to get our slice of that pie, right, as soon as possible. So definitely talk to me if you have someone who is strapped for cash, and they can look at that program and see if it's something that might fit their budget. And then a jumbo loan, we've got a 5% jumbo loan product as well. Okay, appraisal requirements. This is something I'm sure you didn't think I was going to get into. We've got conventional FHA, USDA, they all expire after 120 days. And then our VA appraisal randomly expires after day 182. So just keep that in mind. If we have a transaction that ends up getting pushed and pushed and pushed, we might have to go out there and get a recertification. And then, after a whole year, I believe we have to get a brand new appraisal, but we can just get it recertified, which is like $100 versus getting a whole new appraisal.
And to highlight, because this question comes up from time to time too, even if it's not done by us, if a property is appraised as a VA property, even if they went with another lender, if they come to us, we still have to use that original appraisal. So the VA has their own, and FHA is similar. They have very specific guidelines. So if you have a VA appraisal and you don't like the value that it came back at, and you want your client to come to us and redo it again, they're still locked into that VA price for that timeline.
Yep.
They're very particular.
Yes. So these are just fun loan terms that I figured we could go over. You're probably going to hear us talk about these, like whenever we send my assistant sends weekly updates to all of my agents when we're under contract. So you'll probably see some of these words come through in our emails. Property type, single family versus a PUD versus a condo versus manufactured. It's important to really be upfront with your loan officer about what kind of properties your clients are looking for, because they're all handled extremely differently. Single family and townhomes are generally handled the same, but if you're going into the condo and manufactured side of things, definitely let me know up front. They're going to need a little bit more time to close because they have some other other hurdles that we have to cross over. They're not terrible hurdles, but they are hurdles indeed. Loan to value. So the percent of the home's value versus the loan. I'm sure you guys learned a lot about that in your realtor classes. Debt to income ratio. This is like probably the word I use the most out of every mortgage term there ever was. This is going to be the amount of monthly debt that your client has versus the amount of income that they have. The underwriter, this is going to be the person that reviews all of the loan documents to ensure that they meet our investors' guidelines. Our processor is my partner who helps in gathering documentation and works with underwriting to clear those conditions. My processor's name is Angela, and she works on every single one of my loan files, and she's amazing. And of course, if we have a jumbo loan, it goes to our jumbo team, and they're also fantastic. Our closer, another member of our team who is going to prepare those final closing documents and send them to the title companies and the attorneys and relay those fees for closing. A condo specialist. This is what I was talking about earlier about condos. So we have an entire team that is set up to review every condo that we have come through our system. And they reach out to the HOA management company and get all of the budgets, all of the insurance documents, all the fun stuff for that particular closing. And they let us know if the condo is approved or if we need to switch the program or what we need to do if we need to get more information, etc. We have an amazing condo team, just so you know. We have a letter of explanation that is sometimes requested. This can also be called an LOX. Letter of explanation can be for anything from an HOA, HOA letter to stating a big deposit, to a leave of absence. We use these for all different types of holes in our file. So whenever we have a file that looks great, we say, okay, where are the holes in this? Where could the investor push back? And we ask the client to explain that situation. Verification of employment. We're going to verify that that the buyers are still employed before we close the loan. And that's what that is. We've got our loan estimate, which we already talked about. Our closing disclosure, which is going to be the more final document from that loan estimate. We're going to take that loan estimate and we're going to get all of the taxes, all of the insurance information, and we're going to update that. And that is going to be your client's final numbers. And then we're going to get into different loan types. Conforming conventional are going to be loan sizes of less than 647,200. And our jumbos are going to be anything over that. Government is going to be FHA and VA loans. And what this means basically for it to be government is that it's government backed, which means that if you do not pay your mortgage, the government will pay it for you. So obviously things happen other than that, but for the investors' purposes, they get paid, and that makes it a little bit less risky for the investor, which is why they have less strict guidelines when it comes to underwriting, and they have the lower interest rates because of that. They also have the upfront mortgage insurance and the monthly mortgage insurance as well, which basically pays for that difference.
If I could just highlight a couple of things Carlin said real quick, because they're really, really cool. So the condo team that she mentioned, we really do. We have an amazing condo team. One of the things you talk about, what does it mean to you? Like, what's in it for me as far as impacting your clients in your day? What our team will do is if something's not right with a condo, they'll engage the condo and the association to see if they can tweak some things to make the loan from not able to be approved to approved. Now, that seems almost like a common sense thing to do, but what I can tell you, in my past, I worked at big banks. If it was declined, it was declined. Nobody was doing anything with it. Nobody was touching with it. That was the end of the story. So what you get when you come in and you work with Carlin and the team is there's a little bit more control over the process. A no isn't just a no like it is at other places. A no is at the beginning to a conversation. How can we create a yes, or is there a way to create a yes? And they're really good at finding holes or finding ways to tweak things to make the solution go from we can't do this loan or we can't do this condo to we can. And a lot of you are aware, condo guidelines have really tightened up in the last year a couple different times in a couple different ways. So finding ways to be creative and kind of navigate that landscape is super important. So the team that we have here backing them up is awesome. And the other part, when I talk about control, which is what hopefully we can offer you in the process, more control, more hands-on, because Carlin is physically there in the office, but control for her, again, when I was at a big bank, when I put a loan into process, it went to one of 8 different processing centers across the country. So I never knew who was going to have that loan. Carlin has a one-on-one relationship. So when her loans go, she knows exactly where it's going. She knows who to call, how to contain it, how to keep things moving along. What I can tell you from somebody on the inside, that is night and day as far as how much your process is smooth and easy. So those are 2 things that Carlin's got behind her that make things a lot easier for everybody involved.
That's right. And you, of course.
Oh, go on.
All right. So a little less fun is our derogatory credit events. This is just going to talk about how long they are going to have to wait to finance a house when they've had a bankruptcy or foreclosure. Again, this is not something that you need to know, but it's something that you could know and you could just have a little talking point on. But of course, send them to me for a final, decision on whether they should apply or not. Okay, so as we all know, the industry can be a little challenging, right? We just went through derogatory credit events, debt to income stuff. There's a lot of things that can go wrong in the process. So let's talk about some of the challenges. I am very much known for my creative lending solutions. I have saved a number of deals just by working around and changing numbers and taking over a loan from another lender. So just keep that in mind. And let's talk about how we can work through some challenges that we see a lot. So credit challenges, we already kind of talked about this, about the credit expert that Eric mentioned. I also have an amazing credit expert that I work with. Her name is Lucy, and she is seriously so caring and will work with your buyers for years to get their credit right. I'm not saying it would take that long, but I'm just saying she's very dedicated and very caring about people. So we can get her involved with the client at any time. So we just need to work on the credit, work on the appropriate programs, make sure we connect them with Lucy, or potentially put them into the credit expert program and see what we need to do to get those scores up quickly. Debt to income challenges. This is probably the number one thing that I deal with if someone doesn't qualify for a house. And it might not necessarily be because they don't have enough income, but that we might not be able to verify that amount of income. So let's say someone who's self-employed, who writes off a lot of their income, they're not going to have the same amount of debt to income ratio as someone who claims all of that income. So it's not necessarily an issue with them not making enough money and not being able to afford the home. But sometimes it's just a matter of just, dotting your I's and crossing your T's. So adding a cosigner would be an option here. Paying off any current debt, like any low credit cards that have high payments. Those are the first things I'm looking at when I have a debt to income issue. Lowering the loan size, of course, is going to lower that monthly payment, which lowers that debt to income ratio. And of course, making sure that you're amortizing the longest amount. So a 15-year mortgage is going to have a higher payment than a 30-year mortgage. So we can kind of adjust it that way and work around it. We can also buy down the loan rate. That's an option. That's really probably one of the most impactful ways to do it, because your money is going to go farther buying down that interest rate than it is applying that to your down payment. Asset challenges. So gift funds from a relative, seller concessions, which we already talked about. And then of course, lender contributions. We can always, work through the loan, raise the interest rate a little bit to give them credits at closing to cover those funds. And of course, we have our low zero down programs that we can put our clients in if they are really interested in that. Cool. Is everybody just bored or what? Is everybody good? Checking in.
Big.
All right, so these are just a couple of other things to note. Salaried income can be used up to 90 days before the start date. It's called projected income. A lot of people don't know this. Variable income, commissions, bonus, and overtime. We need 2 years to show that consistency. Self-employed, we need 2 years as well. And we, of course, use net income on that calculation. Second jobs, we need 2 years seasoning. I get that question a lot. Can I just pick up a second job and use that income to qualify? And the answer is yes, but in 2 years. So alimony, child support, we need 12 months of received payments. And same with other receivables like annuities, royalties, we're going to need 3 years of continuation on those, which is usually not hard to get because in the agreement, it usually states how long, and it's usually a while. Okay, retirement accounts can be used if a set draw is being used. So those are generally case-by-case situations. So if you have a situation where you're wanting to set up a draw on your retirement account, give me a call. General income guidelines, though, we're going to want to stay around 43% on pretty much all of ours, but conforming VA FHA can stretch to 50 to 55%, just depending. VA, actually, I have seen quite higher than that. They just, again, the government-backed agencies have a little bit more flexibility. So if we need to put our people in those programs due to any debt to income issues, we definitely can, and then refinance them into a conventional loan as soon as we can. Cool deal. All right, pre-qualification versus pre-approval. So I get this all the time. I'll have people apply and they're like, oh my gosh, yay, I'm pre-approved, I'm pre-approved. And I'm like, wait, hold your horses. You're pre-qualified. We still need to get you through underwriting. We need to get your driver's license. We need your pay stub to verify your pay. And we need a couple, the bank statements showing that you have the amount of money needed to close. So it's not always like that, but most of the time we do need that. So I always say this, we need to, let me start by saying this. I come from the South where racing is very ingrained in my blood. So when I think about pre-qualification, immediately, I was like qualifying for a race. So I always tell my people, you need to pre-qualify before you can run, before you're approved to run in the race. So make sure to not get these terms mixed up because it can really get you into a bad situation. So keep this forefront of your mind. You have to pre-qualify before you are approved to run in that race. Eric, do you want to say something?
Well, I was going to keep it on the car related themes. I like to also say, everybody on this call has probably had a situation where they put a loan into process and they're like, well, I know I had the pre-approval letter in front of me, but then it fell apart before it went to closing. Like, well, how did that happen? Like they already said that they were going to be approved. So I always use the analogy that, it's like taking your car into the shop. So if I took my car into the shop and I said it's leaking oil, they would say, I don't know, it's probably this. And I don't know anything about cars. So it's the flux capacitor. So, they would say that that's what it was. And then they would call me back a day later and they'll say, Mr. Spotswood, it was this, this, and this. I'm like, well, why didn't you tell me that yesterday? They're like, well, I haven't looked under the hood of the car yet. So I really didn't know what was going on until I looked under the hood of the car. Well, that's the difference between pre-qualification and pre-approval. Pre-qualification, it's just all stated information. We haven't looked under the hood of the car. We haven't gotten the documents to validate it. We haven't been able to see that what they said is actually true. And there's some subtle differences that can make the difference between really being approved and not being approved. So until we really look under the hood of the car and do that underwriting, we don't really know what we're up against. So that's, and I'm sure, Carlin will talk a little bit more about how we can offset those concerns for you. But that's the big difference between just getting a generic approval letter and really having approval in hand.
Yeah. Like you said, I mean, there's so many little details that can be just a little bit off. One checkbox saying that they don't pay alimony, not checked, and we're kind of in a pickle. So that is why it is really important to get every one of our clients into the Buyer Advantage program. It is a game changer. It is going to help us stand out. And it's going to give us peace of mind. Everyone, you, me, the buyer, the seller, everyone. There is not one negative thing about getting into underwriting and being prepared. So a little bit more on why we would do this. Eric, do you want to jump in before I get in?
No, go for it.
Okay.
Go.
So it's completely free. It is completely free. We're going to stand out against any other pre-qualification letter that someone's throwing in there. And like I said, peace of mind. We're going to get all of these documents looked at by underwriting. They're going to give us the go ahead, and we're not going to have to worry about, do we need to verify any more of this information? Another thing that is really important in this market is giving us the flexibility of a fast closing date. If we're Prosperity Buyer Advantaged, we can close this loan in 14 days. So that is how important this is right now. So of course we need to get the appraisal back, but as soon as we get that appraisal back, we can close that loan because we already have everything in the file that we need. So it is really, really important. And not to mention, we have a $10,000 closing cost guarantee that once we get your buyers in this program, we're going to send a letter to the seller and say, hey, seller, you're kind of silly if you don't choose our offer because we've already been through underwriting. We already have our approval, and we're going to give you $10,000 if we don't close this thing. So it is seriously helping. It's changing the way that my agents are getting business. So we're definitely getting a lot more.
In a tight market like this, when inventory is so lean, trying to win and set your offer up versus anybody else's is great. So like Carlin mentioned, it's free. So how come all banks don't do this? The reality is all banks don't do this because of cost. Because if I'm going to assign you to an underwriter, I'm going to get a processor involved. I'm going to get all of my compliance group involved. That's a lot of lenders are going to look at that and say, what if you don't get a home, or what if you don't pick me? I just wasted all that money. Well, we're looking at the other way. What if you do? What's the difference in your experience? And for you personally, that situation is so painful that I referred to a moment ago, where you get all the way into process and that's the week of closing and it falls through because of something that happened in the review. You can avoid that happening. You can have that review because the problem is going to be the problem no matter what. But find it before you put a contract on the phone. Find it while you're shopping so that we can figure out how to solution it. Because a lot of times, like Carla mentioned, she's super creative. She can figure out a solution for it. The problem a lot of times is we just run out of time because we find it out 3 days before closing or 4 days before closing. So you can find it out while you shop. We can figure out how to pivot, adjust things, have the file still be approved. And then when you sign that contract, you can feel super, super confident in it. The other thing I'd mention is when you're putting these in, it absolutely should be a differentiator for you versus anybody else. If there's an offer going on a home, you got 10 offers, they're all generic pre-approval letters, and you go in with this fully underwritten loan commitment, But what I would advise is make sure that the listing agent is aware of just how strong this offer is and what exactly it is. Because sometimes people send it over and the listing agent looks at it, they're like, well, that paper's pretty, but they don't really understand what it means. So you have to spell out to them like, hey, I just want to make sure that you know about this offer. This is a fully underwritten, fully signed off, not a generic pre-approval. What we found is when agents take that extra step of really making sure the listing agent is aware of just how powerful it is, it really makes the offer stand out. And the other thing I'd put on that is if you're putting in one of these offers, leverage Carlin. She can call the listing agent and she can say, hey, let me tell you about this letter that you just got. Let me tell you about where we are in the process. Let me tell you about all the sign off that we got. We do that all the time. And I've heard a number of stories where listing agents have come back and they're like, that's the reason why I picked this offer. Because I had talked to the lender. I knew they were local. I heard about how strong their offer was and it made the deal stand out. And that's why I picked it. So let us work for you. Everything that she said and everything I just said, all free. Completely complimentary, all business.
Yep, absolutely. And I love to talk to listing agents, and I'm very convincing, by the way. Do you guys have any questions? I know we kind of just ran through all that information, and I will share this this presentation with you guys.
I didn't want to jump in before, but I thought of something after, like 2 slides after you mentioned it before.
Yeah.
It's top of a lot of people's minds right now because the market's gone bananas the last 2 years is the appraisals, and appraisals are coming in low. That's tough. My heart goes out to our appraiser friends out there because it's a tough market. When things escalate this fast, it's hard because they're always appraising, looking in the rearview mirror. They have to use sold comps. So it's hard when you're in an escalating environment to keep up with the pricing. But one of the things that makes it even tougher is when you get an appraiser and they're not local. Carlin mentioned it on one of the slides, but I really want to highlight it. You have somebody in there in Orlando and you see the appraiser and they're coming from Minnesota or they're coming from Daytona and you're like, what are you doing here? Like, you're not from this area. You're not from Windermere. You're not from like any of the local markets. So the thing that we do that offsets that is we have a panel of local appraisers that was sent to us by you and your peers. So they're all picked by Berkshire Hathaway. And they said, these are great people in the local market. So what 90+% of lenders do is they use what's called an appraisal management company. The appraisal management company, what they do is they put an order out around where the house is, but they're going to charge the client, we'll use an example, $500. Well, for the luxury of finding that appraiser, they're going to keep, say, $150, maybe $200 of that. So they'll go to the local market and they'll say, does anybody want to take this order for $300? And when they say no, they open up the circle a little bit, and then they open up the circle a little bit until they finally get somebody that accepts it. And that's why you get appraisers from these far distances coming in. They don't know the local market. They only got $300 and they're driving from 2 hours away to do it. So they swoop through the property and leave. So what we have is the group of local appraisers that you all and your peers sent over to us. And that's why we see our values come in. It's an occurrence rate of less than half of what the market sees, that our values come in undervalued compared to what the industry sees. And it's really because of that. And it's because we got the information from you and your peers, and you all know the local market. So it's a huge differentiator and way to protect your deals. And again, doesn't cost anybody a dime.
I love that. Perfect. So no questions? Okay.
Carlin, could we maybe present to Eric? We had a question yesterday on our call.
Bring it
where
on.
people, okay. So, and I think the answer is just that it varies, but these separate apartments, either a garage apartment or an in-law suite connected to the home or a separate suite, not all the appraisers include that.
Yep. Yeah, and you hit the nail on the head, Dora. You've been around the business long enough. Yeah, the answer, like a lot of times in lending, is it depends. It depends on what the comparables in the market. It depends on if they can't consider it an ancillary unit, and are they including it in the overall square footage. So it really kind of depends on how that setup is and what the local market says. So depending on how that answer is answered depends on whether or not you're going to use it or not use it. So one of the things, again, kind of so I know it's along those lines, but not directly answering that. One of the things that we're going to do that's different is we have an appraisal review team on hand. So again, in my past, I'm not trying to throw anybody under the bus, but I worked at a big bank. If the appraisal came in low, it came in low. That was it. End of story. Nobody's touching that. When it comes in low with us, we have an entire internal appraisal department that before we even go to anybody and say that it's low, is going to do a full technical review of that file to make sure that we agree with what they're saying. We don't feel like there's anything materially deficient in their review. If we have questions and we feel like there is, we're going to reach back out to the appraiser before, because we're not going to wait for you to tell us to do it. We know you want us to do it. So we're immediately going to reach out to them and say, hey, we have these questions. Can you explain why you didn't do this, or why you didn't include this, or why you made this note, and see if we can get them to relook at things. And sometimes we'll see them actually adjust their review and tweak the value before we ever have to communicate it to the client. And the last thing, and really very few, if anybody in the market's going to say this, if we look at that review and we feel like it really is materially deficient, I'll toss that appraisal out and I'll order you a new one and we'll pay for it. So if we look at it, I'll give you an example. Had somebody use a room that was upstairs, had a pitch roof room, and the technical rule, if at least 50% of the room is 5 feet or higher, then you can use that as square footage. But if less than 50% of the room is 5 feet or higher, then you can't. Well, more than 50% of the room was 5 feet or higher. So it was usable square footage, but the appraiser said, no, I'm not using that. That's not right. We're not going to do it. We said, it absolutely is right. You definitely should. They refused to do it. We tossed that appraisal out. We ordered a new one on ours. We rushed it, got it back. The new appraiser used the square footage. The value was fine. We were good to go. So we'll do that all day. So when you have these one-off scenarios, we have an appraisal manager. His name's Derek Owings. We're looking to set up a tour where he'll come in and chat with the local market probably in March. So maybe coming soon to an office near you, but he'll get on the phone specifically with the appraiser. He'll get on the phone specifically with you all and talk over, here's what I'm seeing. And he's been an appraiser for 20, 25 years. So he really knows his stuff. So he can dig in with the appraisers. He can dig in with agents, make sure that he's going over the fine tooth details of everything to make sure that you're getting the value that you're supposed to get.
Thanks.
He's awesome. I can get him on the phone, Dory, today, and we can actually ask him that.
Okay.
I owe him a call anyways.
Okay. Yeah, and I think he's coming. I think he's doing a presentation for us, Eric, coming up.
Yeah, we're trying to put together. I'm working on his calendar. He's booked up in February, but I think he's free in March. So I'm going to see if I can get him down to the local market in March to shake some hands and kiss some babies.
He actually did one with us last month virtually.
Oh, nice.
We had a couple of technical errors, so we really need a redo. Yeah. So that's really it, you guys, except for I have one more surprise for you. I want to introduce you to Jay, who is my assistant and my transaction coordinator. And I want to show you how amazing he is. He's actually a saxophone player in a band, and he's so much cooler than I am. And so I just wanted to show you guys kind of who he is and let you hear him for a second. So on top of being in a band and being just so cool, he's also a cancer survivor and just an overall amazing person. He will be my transaction coordinator. He helps me get everything through the pipeline. He's another person that you guys can reach out to if you have any questions and you can't get a hold of me. But I will, on our next sales meeting that I'm in, I will have him on there and he'll introduce himself and we'll give you guys his contact information. But that's it, you guys. Thank you so much for coming and joining me today for this Realtor Reference Guide. And I will see you guys on the next one. Bye.
Thanks, Carlin. Good to see you, Dory. Renee, Laurel, iPhone. Good to see you guys. Have a great day.
Bye, guys.